Morning, here we are, Thursday morning. The market just opened a few minutes ago. I'm not even sure what it's doing right now. I haven't looked yet. But anyway, I wanted to go over a situation that is going to happen if you invest in stocks, and particularly in stock options. I mean, the reality is that investing in stocks is risky, right? Prices go up and they go down. Uh, we use options to actually help mitigate risk and to reduce the damage when our assumptions are incorrect and they don't pan out. So anyway, Ken Krager from Black Swan Financial Advisors on my Black Swan Breakthroughs podcast. Thank you for joining. All videos are for educational purposes only. There's my website, which is under construction. Hope it is up and running by 1st of July. Please subscribe to my YouTube channel. Watch my videos. I think they're valuable. I mean, I just do things that I wish people would have done for me years ago, and share information that I would like somebody to share with me. And then there's an email address for you if you want to get in touch with me. So let's jump right into it. So what happens? Stock option trading disaster. What do I do? What happened? So like I said, not all trades go according to plan. If that was the case, we would all be filthy rich. Everybody, right? Because everybody would invest in stocks and we'd all make 100% a year and we would be rich. So stocks are, part ownership of companies. Companies go bankrupt. Companies don't do as good as people think they were going to do, and the economy gets tough or whatever. But for whatever reason, stock prices go up and down, and options are a derivative directly related to the price of the stock. So options prices go up and down with the stock prices. And the reality is that not all trades, go as planned. And one of the reasons that we use options is to actually mitigate the risks. So for example, I want to buy, right now, Nvidia is really hot. Microsoft is doing really good. And so say I want to buy Nvidia and I want to get it at a discount. So we've talked about this before. You can sell a put on Nvidia. Somebody will give you some money, and actually you're almost hoping you get put that stock so that you can get it at a discount. But a lot of people sell puts to get income and they don't actually want to own the stock. So we're really kind of talking about that situation where you're doing these option trades to get some income like every month or so, and you don't necessarily want to own the stock, at least for the long term, but you want to be invested in it. You like it, and hopefully you're following your rules, whatever rules that you set up for yourself. You need to have these rules ahead of time, okay? One of the rules that I like is most of my options trading, not all of it, I do a little bit of speculative options trading, but most of my options trading are to sell options on stocks I want to own anyway, like Nvidia, Microsoft, Home Depot, whatever. Okay, these are companies that I would go buy stock in directly. Way back when, before individuals, could get an E-Trade account or whatever and easily go trade stock options on Robinhood or whatever, I would have called up my broker at Charles Schwab and I'd say, buy me some Intel or whatever. But another rule is it's really, really important to do your position sizing so that if you do have a trade that goes against you, it doesn't blow up your overall portfolio. And this is an area that people really get in trouble because options look like they're cheap. They're a fraction of the cost of the stock. But you have to remember that they control each one options contract controls 100 shares. And if the trade goes against you, the options are leverage. So if the trade goes against you, you could have taken on a lot more obligation than you had thought, okay? Let's just use an example. If I have a $100,000 portfolio and I ever only want to lose maybe $1,000 per position, and I use a 25% stop loss. So each of my positions might be $4,000. Okay, so $4,000 positions, that if I have a 25% stop loss, that means that I would only lose $1,000, and when I'm down $1,000, I would sell that position and get out. So $4,000 in a $100,000 portfolio is 25 positions. So you could buy into or invest in 25 positions, and that's all. So what would happen if you decided to put $20,000 into one position and it lost 25% of its value, right? So all of a sudden you're down $8,000 or $10,000, okay? Or heaven forbid you put half of your portfolio in one position, $50,000, and you lost half of it. You just lost a quarter of your portfolio. So, and then lastly, a loser doesn't always end up being a loser. And I'll show you why or how, and then I'll share a little thing about my brother in just a minute. So this is an actual example of a trade that I did years ago. 2010. In 2010, Intel was one of those companies that I wanted to own. It was top dog. It was dominated the market. It had 80% of the market. And man, it looked like it had really good value. Earnings, imagine having a price to earnings of 9. I think right now, even with the market down, it's like 19 or something. But this seemed like a perfect long-term investment, something that I would like to own. So I decided, instead of buying it outright, I'm going to sell a put on it, right? So that's what we talked about doing. So this is what happened. So here's a chart. 2010, it's August, and price was 1947. And so I sold a put for with a $19 strike price, and I got 47 cents. So so basically my strike price is below the current price. So I automatically got a 47-cent discount. Plus I got 47 cents, right? So that's what, 94? Almost $1. Almost 5% of that price. It was only a couple of weeks and it would expire. But price, Intel was going up. And in hindsight, in the next 21 months, Intel would go up 50%. So, but with options, you have to remember that you have a time component. And so not only do you have to be right on the direction or the price action, which direction the price goes, but you have to be right in the time frame, because your option has a time frame, okay? It's one of the best companies in the world. So we sold a put. Okay, so what happened? At expiration, somewhere around a couple of weeks later, the price was below $19, right? So if it's below $19, the $19 strike, I got put the stock. And I get put 100 shares per contract. Okay, now I was a lot poorer then, and so I only had, 1 or 2 contracts. But I got put the stock, so what is my cost basis? Okay, well, my cost basis was the $19 I had to pay for it, and that's why position sizing is so important. What if I would have had 10 contracts instead of 1? So instead of $1,853, I would have had to come up with $18,530 if I had 10 contracts. So anyway, the strike price minus the money that I got up front, my cost basis is $18.53 a share. And it went, you can see it went below that a little bit. But actually, I'm pretty close to my cost basis. Technically, I have a loss, technically, right? But I'm in a company that I wanted to own anyway. I mean, I could have bought it for $19.47 a couple of weeks ago, which is what I would have done in the past, right? But I got it for a discount. I got it for $18.53. But what can happen now is I'm going to make more money off of this. I got put the stock and I own it. So another thing that you could do if you don't want to own the stock outright and have the shares is you could do something called rolling it forward. And I'll talk a little bit about that and about a trade my brother has been doing in 2023 and kind of what happened to him. But you roll it forward. But we're just talking about I got put this stock. But what I was able to do is I turned around right away and I was able to sell a $19 call and I got paid 70 cents per share. So I sold a call. I own this stock now. My cost basis is $18.53. I sold a call, which means if the price is above 19, my shares will get called away and the new owner will own my shares. And a month later, the price was over $19 and my shares were called away. So, was that a disaster? Let's look at it. $19 strike price. Minus the 47 cents I got up front, my cost basis is $18.53. And then I got 70 cents call premium, right? So basically, if you do the math, I made $1.17 per share in about 6 weeks. That comes out to 6.3% in 6 weeks, or 54% annualized return on a losing trade. Okay? So you can see how the options reduce your risk, how you can turn a losing trade into a winning trade, and they're very, very powerful. So now my brother, over this last year, we were investing in XBI, which is a biotech ETF, and I did really good in it. I was selling puts on it for months, and I was making money every month. It just kind of kept trending up. It was doing great. So right about that time, my brother decides to sell a put on it. And of course, Murphy's Law, right? This same exact thing happened to my brother. And so what happened is he didn't want to own the shares because it ties up money in his account. So, and he had a pretty small account. So he decides to roll it forward. So what you do when you roll it forward is you buy back the put that you sold, that you're losing money on, and then you sell one further out, so like a month out. So you might buy it back and say you lose $1 per share. You need to go far enough out that you get more than $1 back. And if you can, you try to lower the strike price so that through time you can do that. So that's exactly what he did. Is he picked a little bit lower strike price. He sold a put that gave him some credit. And 4 to 6 weeks later, when his put came due again, it kept going down. And so he rolled it out again. And then he rolled the puts forward 3 or 4 times, and then he finally got put the stock. Okay? So now he owns the stock. But he's been making a little bit of money every single time. And so his cost basis is going down. It's still higher than the price of the stock. But then he turned around and he sold calls on it. And actually when you sell a call, you actually own the stock because you sell the call on the stock that you had. And actually the Intel trade worked out even better because if I remember right, during this time, I got a dividend payment on top of the call premium. So actually I made more than that. So anyway, so my brother starts selling calls. It took him like 10 trades. It took him almost a year, and then he was profitable. So instead of taking a 10 or 15 or 20% loss, he just kept rolling these forward, and he used this same strategy of selling a call, and he actually ended up at the end of the year profitable in that trade. So that's what you can do. Very powerful. Thank you for tuning in. I hope that was very useful. If you get my advanced options course, you'll see how you do this, how you roll things forward. We'll do real trades. So thanks again. Ken Krager from Black Swan Financial Advisors. All that we talked about is for educational purposes only. Please subscribe, contact me.